Breaking news. As of last Wednesday, May 20th, 2020, the Federal Reserve balance sheet has crossed over $7 trillion for the first time in the history of the United States. Well, the world, actually, honestly, speaking of which. So I'm going to go ahead and circle back around to this key piece of information because I want to talk about what is to come. What are my thoughts on what's going to happen next? But I can't help but think the parallel things, right? Like CNBC, CNN, all these news outlets are talking about how there are similarities between 2008 and today. But I want to talk about why for the last 4 years, I have actually been saying that there's going to be a crash happening in 2020. Matter of fact, if you go back to our live streams that we broadcasted in early 2019, mid 2019, you'll actually see that I've been saying third quarter of 2020 for a very long time now. Matter of fact, I've been saying that since 2015 is the earliest that I've been saying, based on what I've been seeing. And I want to break down for you guys, and this isn't a video by any means of saying, oh, like Daniel was right, Daniel was chicken little, right? He's been saying the sky has been falling. That is not this type of video. If anything, I want to break down for you guys why I was saying that it was going to happen this year and what are the things that made me, what are the facts, the articles, the research, the numbers that I have been seeing to make me go to that conclusion. So I want to go back in 2017. So fall of 2017 is actually when I bought my last apartment. I haven't bought an apartment the last 3 years, and I'll tell you guys why here in a second. But fall of 2017 is when I closed on the last apartment building I bought. I bought a 24-unit building. I bought two 12-unit buildings right next to each other, and I closed on that baby November 30th of 2017, right? So if you actually go on my personal Facebook and you go all the way back to November 30th, 2017, you'll see 3-year younger version of yours truly, Daniel Kwok. But I bought it at, $1.5 million at a very average normal price for that market. But I noticed that I was competing with more offers than usual. Matter of fact, I had to compete actually against 15, 16 other offers, some of which were actually cash. And I bought it owner financing, and we actually beat out some cash offers that were included in the 15, 16 offers that we had to compete against. But around that time, it made me think, man, is there a potential bubble going on? I saw the Big Short movie, and there's a lot of things that we speculate about when we turn on the news. And so I started paying attention to what was going on, and I quickly realized, because truth be told, up until then, I didn't research a whole lot of things in the market. I dabbled, I played around with it. I had a lot of conversations with different people who are a lot smarter than I was, who told me that they think that the recession was going to happen in 2020, even back in 2015. But I didn't dabble too much, but I started really getting into studying the market, what's going on here, what's going on over there. And well, I saw that there were bubbles that started to get created in not only the credit space, but also the financing space, especially car loans. And man, car dealerships were literally throwing out car loans like it was candy. I also saw a bubble happening in the mortgage-backed securities market, along with the funds market. Student loans around this time were starting to get traded in the secondary market, along with real estate. And I'm sure you guys all remember this craze, the Bitcoin craze that was happening in 2017, 2018. But I started noticing a lot of bubbles. And I looked into the mortgages market because I knew these mortgage-backed securities were very reliant, obviously directly correlated with the performance of these mortgages. And well, in 2007, 6, 5, we saw a lot of what's known as ninja loans, no income, no job, right? No assets, so to speak. Well, I started seeing these things called NINA loans, which N-I-N-A stood for no income, no assets. And of course, we started seeing a lot of loans and a lot of lines of credit revolving around stated income. I remember seeing that word and then seeing that phrase thrown around left and right. And at the same time, I saw a lot of individuals who were buying properties at literally interest-only loans, a lot of poor underwriting metrics in terms of how they got their commercial loans. So I started seeing a lot of bubbles going around. Well, let's first define what is a financial bubble. So my research in terms of different definitions, and also my own personal experience with seeing bubbles, would tell me that the definition of a financial bubble is a process in which assets and financial entities faced rapid and unjustified surge in price and growth before facing a correction, aka a market downturn. So let's go back to the story real quick, right? So let's fast forward. After I bought that 24-unit building, I took a look at another building about 4 or 5 months later. So I bought, closed on that 24-unit building in the fall of 2017. Fast forward, I'm looking at this building early of 2018. I believe it was around February because I still remember snow being on the ground. So my partner at the time, who knew this market very well. And by the way, guys, the city, this market that this building that I'm looking over in 2018, early 2018, is located in a market, the same market that I bought the 24-unit building in 2017. And I know this market very well, like the back of my hand. I used to own 4 large multifamily complexes there. So I knew this market very, very well. So I pulled into the parking lot, and well, it's a bit of a mess, right? There's syringes and broken glass and garbage all over the parking lot. When I pull in, there's a car right next to me that has all its windows broken in. The windshield and also the back mirror, they're both shattered, right? There's a lot of dents. All the tires are missing, and the car is supported by literally cinder blocks, stuff that you see in movies. I look in the car, and there's, sure enough, garbages, syringes everywhere. And this, the whole parking lot is just a mess, right? It's an absolute mess. Well, my partner is waiting for me inside along with the seller, the guy that owns the building. And we walk in, and the hallway, the interior is no better. If anything, it's worse. I mean, there's stains all over the hallways. There's holes broken into the walls. There's literally garbage everywhere. And I mean, nothing looks anything near rent ready. And so I go into one of the units that is supposedly, according to the seller, turnkey and move-in ready. And well, there's a hole literally right in the middle of the living room. The carpet looks like it hasn't been replaced in 20 years, and it looks like there has been a family of cats, dogs, turtles, anaconda, whatever you want to list, whatever animals create the most amount of mess, it looks like they've been living there. The cabinets are all torn off. Appliances haven't been replaced. It looks like since the 80s, right, or the 70s, whatever it may be. So long story short, the whole building is in horrible, horrible condition. So we look over the numbers, we look at what it could be worth, we look at how much it's going to cost us in rehab, and based on my expertise and my partner's expertise, which by the way, he's been investing in that market, the same city that we're talking about here, the same area, for over 40 years. Right? And I own obviously a lot of apartments in the same area, so I know it very well. So both of us kind of came to the same conclusion that this building is worth $700,000, right? And keep in mind, this was actually another 24-unit building in the same market, right? The 24-unit building I bought and this 24-unit building were literally, I think, a 5-minute drive of one another. So it was relatively very similar. So we knew the market extremely well, and we knew that it was worth $700,000, and even that was being conservative. So we actually offered $700,000 because, well, our plan was let's fix it up, let's rent it out, refinance, whatever it may be. I think we could have a pretty good spread here. So we offered $700,000. We got laughed at out of the building by the seller. Right? And we were just like, oh my gosh, like what does this guy want? This guy's never going to get his price. And I don't know what he was asking for. I think he was just asking for more. But, we were like, this guy's not going to get anything more than $850 on that building, right? Knowing who we are in terms of our expertise and knowledge of that market. I get a call about 2 months later from my partner. My partner is a licensed real estate professional, so he has his plug in terms of what gets bought, what gets sold. He gives me a call 2 months later and says, Daniel, you'll never guess what happened. Do you remember that building that we walked in, 2 months ago? It was horrible. It looked like the setting of a scary movie. And, surprisingly, there were tenants living in there as well, which kind of really shocked me and amazed me at the living conditions some people are willing to accept. But he calls me and says, remember that building? And I say, yeah, of course, it was an unforgettable experience. Who could forget, right? And he tells me that it got sold. And I say, no way. And I'm expecting a number between, maybe $750 to $850, right? Maybe somebody's a sucker and, they paid $850 for it thinking that they can get a lot more, and then they just didn't know, right? I was assuming it was an amateur real estate investor with a lot of money. Maybe it's daddy's money. I don't know, right? But he, pauses, building the suspense, so to speak. And he tells me a number that made me spit out the coffee that I was drinking at the time. And he tells me $1.4 million that this building got sold for. And I spat out my coffee and I couldn't believe it. And I said, who bought it, right? Who is the moron who bought this thing for double than what it's worth? And he says some group out of California. So that right there, my friends, is when I realized that we are in a bubble. So let me tell you what this means, right? Let me tell you how this all correlates, because you'll see here in a second how everything is in a circle. When it comes to economic studies, when it comes to the Federal Reserve, fiscal policy, monetary policy, right? When it comes to when it comes to all the factors, all the major factors that make up an economic landscape, you will see that it's all dominoed, right? It's all interchanging. They're all holding hands, singing kumbaya, right? It's like the Lion King. So what happens? What happens when a 24-unit building in a market in Illinois, it gets sold for double for what it's worth? Well, you start seeing what's called comps, right? And I'm going to give you guys a really good example of what happened recently, right? So one of my favorite podcasters of all time, Joe Rogan. I'm a huge fan of the UFC. I listen to the Joe Rogan Experience almost daily, almost religiously, because of what I learn of the different people that he brings on. And Joe Rogan, as you may have heard and as you may have seen on the news, just signed a $100 million deal with Spotify. And the significance of him signing that deal, it shows the value of content creators online. It shows the value of content creators and how much they are worth. It's very similar, right? Because I'm a huge diehard basketball fan, a Bulls fan, so to speak. I remember when Donald Sterling was forced to sell the Clippers to Steve Ballmer for a little over $2 billion. Well, guess what it did to the value of all the other NBA teams in the league? It raised the value. Matter of fact, there was an article that came out the day Donald Sterling sold the Clippers for $2.2 billion, saying that Michael Jordan became a billionaire because of what Donald Sterling did. Because he sold it for $2.2 billion, raised the value of all the NBA teams, Michael Jordan became a billionaire. Well, same thing that happened here, guys, in 2018. Because that building was sold for $1.4 million, it now sets a precedent, right? In real estate, we know that as comps, comparables in the area, and that right there, right, because it got sold for $1.4 million, another individual that owns an 18-unit building or a 27-unit building or exactly the same 24-unit building can say, well, that thing got sold for $1.4 million. I want at least 1.2 when it could really be worth 800,000, 700,000. So what does that do? It triggers a cycle, because if that's happening in the commercial market, guess what was happening in the housing market? The same thing, right? These $100,000 homes, become $150,000 homes, and then $150,000 becomes $185,000 homes. And well, that makes sense considering all that was happening in the real estate and overall the economic landscape, right? Let's take a journey back to what was happening in 2017, 2018. Money was historically cheap, right? Which, I think it's pretty safe to say that it's been the case the last 10, 15 years, that the interest rate that we're borrowing has been historically low, right? Not like 18.3% like we saw in the 80s, right? But the money was historically cheap. There was an influx of foreign capital coming into investing in U.S. markets and U.S. equities, right? We saw more capital in the multifamily and the apartment complex sector, right? Matter of fact, the multifamily market share for capital increased from 18.3%, I believe, to 26.7%, inflating the cost of multifamily and apartment complexes all across the nation, right? We had a surge in real estate syndications, which is your 506 private placement memorandum platforms, in which it gives the little guy the opportunity to invest in these large multifamily buildings and these large apartment complexes. So what happens? All of those things, all of those factors, the cheap money, the foreign capital, contribute towards an inflation in price, not only in the commercial market, but also in the residential market. Because, well, in my home state of Illinois, and in a vast majority of a lot of markets in the United States, we saw a low inventory everywhere. I remember talking to brokers from Dallas, from California, in Seattle, in Oklahoma City, in Kansas City, in Toledo, Ohio, in Florida, in Indiana, Illinois, Wisconsin. I mean, you name it. Every broker was saying the real estate housing market, the single-family housing market, it's so hot right now. You can fry an egg on it. That's how hot it is, right? I mean, even when I was doing deals in South Bend, Indiana, realtor that I was working with, right? She was saying, oh my gosh, the market is so hot right now. The average days on market right now is 12 days, right? Even in Virginia, where I was doing development, market's so hot right now. What it does is it increases the average household wealth. Because why? Because guys, let's face it, right? When you're talking about the average American household, a vast majority of their net worth lies in their primary residence, in the real estate they own, right? Whether it's Mr. and Mrs. Jones, Johnny went off to college, they're renting out the second home as an investment vehicle. Matter of fact, 72% of all rental housing is actually from ma and pa, whether it's an LLC, a small LLC they created, or it's in their own name. 72% of all rental properties, vastly in the single family housing market, is done by guys like me and you, right? The smaller guys, the Mr. and Mrs. Jones, who happens to have 2, 4 units or even 50 units or below. Get this, guys, it increases the net worth of the average household. Matter of fact, in June 2018, Market Watch put out an article saying that for the first time in the history of the United States, the household wealth topped $100 trillion. Meaning in the first time in the history of the United States, the wealth of the household. The average household in America, the total wealth topped $100 trillion. Now, does that mean that they were making more money? No, absolutely not. But it just means that the net worth, meaning the price, the value of their net worth, which, by the way, of course, we talked about, most likely resides primarily in the single family house that they live in, or rental house, whatever it may be, it inflated the price. Well, what does that do, right? What does that trigger? Because remember, everything is a cause and effect. Everything is a circle. Remember, kumbaya. So what happens, right? Well, when the household net worth, when they get financially stronger, it gives them the means to go out and borrow more money because they are financially more capable. Well, if that happens, what does that mean? It means more capital going into the investment markets, going back into the market, creating, again, this pattern once again of more money, more capital into the market, cheaper money, all competing for the same commodity. Right? The demand gets greater while the supply stays stagnant. Right? I remember these development companies that were building 300, 400 unit multifamily, and they would have vacancies of 98, 99% within 6 months of them building it. It was just unheard of. Well, what does this mean, guys? When these bubbles keep going and going and going, and these patterns keep occurring, it just needs one domino to fall to have everything cascade, to have everything fall apart. That's what happened in 2008 with the mortgage-backed securities market. One domino fell and everything came falling down. Well, I remember this one day I was in my buddy John's office, right? He lives in Indiana, and we were talking about what is going on. And well, he started telling me the story how, back in '08, the Obama administration was very aggressive. They were very aggressive with getting the economy back into order. And they started doing this thing called quantitative easing. They started printing money, and they started pushing and pretty much pumping money into the markets. And well, they did it mainly in the form of U.S. bonds, in the form of U.S. Treasury bonds. And well, these Treasury bonds have a lifespan of 10 years, right? So if you turn on CNBC or Fox Business, whatever it may be, you'll hear that word, the 10-year Treasury bond and the 10-year Treasury yield being spoken about a lot of times. Well, guess what year a majority of these 10-year U.S. Treasury bonds were issued? They were issued in 2010. Add 10 to 2010, you get 2020. And let me give you guys some numbers right now because we're circling back, right? Right before I made this video, literally right before, and you guys can check it out too. Go to usdebtclock.org and you can see what is in the current U.S. debt market right now. And well, right now we have in national debt about $25.7 trillion in U.S. national debt. Guess how much of it is in publicly issued securities, which pretty much is U.S. Treasury bonds, whether it's bought domestically, whether it's bought by China, whether it's bought by Brazil, Argentina, it does not matter, right? Whether it's bought, whoever buys it, guess how much of that $25.7 trillion in national debt is publicly issued securities? $16.1 trillion.
$16.1 trillion.
Meaning about 70%, right? 68% to be exact. 70%, guys, 70% of the national debt is from the bonds, in which a majority of those bonds were issued in 2010. So guess what, guys? In 2020, those bonds eventually come due. There is a time where every debt, every loan has to be paid back. And guess what those 2010 U.S. Treasury bonds were due? They were due in 2020. The minute I saw that, I knew that there was going to be something happening in 2020. And well, guess what, guys? Ironically, around the same time, and you can go check this out, guys. There's an article that came out in November of 2010 saying that QE2 would total $900 billion, right? $900 billion, that's quantitative easing. So at this point, I knew that there was going to be four things that would happen, right? And I was saying this in 2017, 2018, right? Mainly, obviously, 2018 to 2019, once I was aware of this information. But I knew that there was going to be four things, right? But let me start with the first three things. And the fourth thing is actually what's happening right now. So the first thing I knew would be war. Right? If you actually go back and you study the history of what happens with recessions, economic downturns, and ironically, when wars start, you'll see a lot of alignment. But I knew that war would be possibly one of the things that would happen to adjust. Because let's be real, our government makes money issuing war bonds. That happened, when we started in 2001 with 9/11. It happened even all the way back to World War I and World War II in terms of how we finance these wars. Another would be a major market correction. Now, we saw that in 2008, and we're seeing a little bit of that now in 2020, all right? And that's still on the table. That still may happen. In 2020, maybe perhaps the late part of 2020, we might see that. But based on what you hear on the fourth thing, you may think a little differently about that here in about 30 seconds. Let's talk about the third thing, and that's an economic fiscal change, a major economic fiscal change. What that means is an entire change, a huge major change. A good example of that would be in August 15th in 1971 when President Nixon took us off the gold standard. That's a major economic fiscal change, right? A lot of people were speculating that the major economic fiscal change was going to happen in the form of cryptocurrency, right? In the form of Litecoin, Ethereum, and Bitcoin, that we were going to go to the digital age of currency, right? I'm not so sure about that right now, to be honest. There are a lot of things still up in the air. We might go back to the gold standard. There's a lot of speculation again, but I'm not so sure. The most sure thing, however, and what is happening now is the fourth thing, which is money being shoved into the market. So let's go back to what I said literally in the first couple sentences of you watching this video, right? I said that for the first time in the history of the United States and history of the world, economically speaking, on Wednesday, May 20th of 2020 of this year, the first time the Federal Reserve balance sheet has crossed over to $7 trillion, over $7 trillion. And let me give you guys a perspective. Let me give you guys a perspective on what that really, really means, right? So let me throw out some numbers, right? I got some notes here in front of me. In September of 2008, right? So going back 12 years ago, September of 2008, there was $995 billion on the Federal Reserve balance sheet. In September of 2011, just 3 years later, there was $2.86 trillion. So you're talking about a $2 trillion spread. In September of 2019, we were at $3.7 trillion, right? So there's about a $1.7 trillion spread between 2011 and 2019, which is great, right? That's a pretty slow pace. It's a very respectable, slow growth. Right now, right, it's not even September of 2020. It hasn't even been a full year, and yet we have jumped up $3.5 trillion in terms of what is going on and what is happening in the Federal Reserve balance sheet. So guys, all this to say, I don't know what's going to occur. I don't know what's going to happen. Option 2 might happen. Option 3 might happen. Option 4 is already happening. Do I think there's going to be a huge dip in the market in terms of values? Do I think there's going to be a huge hit in the recession? My opinion right now says no. Because with the amount of money they're printing back into the markets, people eventually, time will pass and the investor psychology will come back into the market. They'll go back to investing. They'll go back to buying stocks, real estate, et cetera, et cetera, et cetera. Are there going to be opportunities with defaults, short sales? Absolutely. That happens with every recession. That happens with every downturn, and we are experiencing a downturn right now. That is going to occur, which is why I'm setting up my opportunity fund to take advantage of those opportunities. But do I think it's going to be horrible beyond 2008? We have to see. We have to see how much money gets pumped back into the market, and depending on that, I think there's a lot of things that are unanswered for now. Right? But again, guys, I'm glad I got to break down what I saw in 2018, 2017 that led me to say that I think something major is going to happen in 2020. And something did with the whole pandemic, with what's going on right now. It's just really interesting, and we have to see how the Federal Reserve and how the fiscal policy aspect respond to what is happening with the downturn. So again, guys, hope you journey with me. Subscribe to this video if you want to follow me on that journey of discovering what's going to happen in the next coming months and the next coming years with the economy, with the Federal Reserve, with fiscal policy. Subscribe to this video, share this video. Let's all start a discussion and let's get through this thing together. All right, guys, love you. I'll see you guys in the next one.